Hey there, I'm gonna say it's Tuesday, and hygiene, of our survive and thrive for 2023 educational series is going to show you how to stretch your money, make more money, do good marketing, and we've asked Lake Michigan Credit Union to share some of their great ideas about construction, loans, money, how to do all kinds of great things and make money in 2023, because we are not only going to survive, we are going to thrive. And we've got the triple J's from LMCU to share with you today, and we're recording it, so see you later.
That's great. Thanks, JJ. Hi, everybody. I'm Jay Malinowski with LMCU Mortgage of Florida. And for those of you who don't know, we're the #1 construction lender in Lee County and in Collier County. And we're working our way up through Charlotte and Sarasota and Tampa, because we just bought a bank in the Tampa market. So now we have 21 branches all the way from Naples all the way up to Tampa. But in regards to our mortgage programs, not only do we offer construction, we offer lot loan financing, which many lenders don't do, 3 and a 5 year ARM with a 30-year amortization. But we only do it because we want the primary residence construction loan or the second home. We're not in the lot loan business to do a bunch of investment lots. That's usually
They want.
really, we need to know that their plan is to build a primary residence. We mentioned we had a huge presence on Sanibel because we've done a lot of non-mortgage condos on Sanibel and on Fort Myers Beach. So we have a lot of sort of creative things that we're doing that you might not find elsewhere. Great rates. The thing about the credit union, for those of you who don't know, I have to sing the praises of credit union, because we're all about the numbers. We give all of our revenue back to our members in the form of lower interest rates on loans and higher interest rates on deposits. So you can actually get a checking account that pays 3% interest. You have to do certain things because it's not a CD, but it'll pay 3% interest on up to $15,000. So we've got many, many things. And I know John and I work together. He's one of my great construction lenders in both Lee and Collier. And so he's very familiar with our construction programs. There's many of them. We're not going to talk to you about all the details, but I know John did bring some flyers with him.
Those flyers over there, yeah, the top sheet shows all our different programs that we offer, and on the other side of it shows a breakdown of what the construction firm is doing. Right.
And then Janet, we like to call Janet our secret weapon. Because not only is she a really great underwriter, but she's a great presenter. So Janice is going to talk to you about all the different programs that we offer, and then we can talk to you also about the creative things we are doing. So,
All right. Yes. Thank you, everybody. Thank you for having me here today.
You're welcome.
We're going to talk about all the construction, perm, and renovation loan options. And like Jane mentioned, we're also going to touch a little bit on the vacant land loan. So first, we'll start off talking about our construction admin team, because it takes a lot of backroom people to facilitate these loans, because there's draws after closing. The Florida Builder Statute, let's see how we handle if there's an outstanding insurance claim or an existing mortgage lien on a property that needs to be rebuilt. We'll talk about eligible renovations, talk about a couple different renovation loan options, 203H, and then vacant land loans. So like I said, our back room is amazing. Builders absolutely love to work with our construction admin team. We have a streamlined activation process to get the builder or contractor approved. Basically, construction admin will review and balance the draw requests. So in Florida, there's a construction cost breakdown or a draw schedule. The builder can use whichever form they want to request the draws after closing as they perform the work. And then, so if the work is complete, we order title, collect the waivers of liens, and we just disperse the funds. And then If there is a hazard loss claim, we'll collect funds and claim reports, and if the claim is less than 40,000 and the loan is performing, we'll go ahead and just disperse the funds. If it's more than 40,000, we need an extra layer of approval. And then the escrow holdback administration, they order inspections when repairs are complete. They, verify the completion, they get the signatures, and they disperse the funds. So the benefits of working with a lender that has a construction admin team, well, for the loan officers, it's tremendous support if the member or borrower buyer has a question. Again, the streamlined process with a really knowledgeable, experienced team. And there's always multiple team members available to assist in a really timely manner. And then for the builder or the general contractor, it's the project funding is secured. So the builder doesn't have to come through with the funds. LMCU provides the funds. So that really helps the builder's balance sheet. We assist in collecting all the correct documentation. We communicate with all parties. So we kind of act as a coordinator between the builder, the buyer. And then again, there's not capital needed because the builder is not using their funds, they're using our funds. And then for the buyers, all the documentation is collected to make sure that they have clear title. I mean, I couldn't imagine if I was a buyer and trying to pay cash and do this all on my own and not have the oversight of a lender to make sure in the end I do have clear title. They have secured financing. It's a one-time close. So they close and then the building starts. So as a realtor, generally you get paid at the closing, not when the home is complete and it converts to a permanent loan. And then with the draw inspections, we have the inspector go out and we are making sure that the value is maintained and that the builder's doing what they say that they're doing.
Jen, can I say something about that?
Absolutely.
So this process, the whole process from start to finish, construction of firm, it's seamless. I have people that I do it for all the time, and they're like, "Wow, this is as easy as buying, getting a regular mortgage." Because you start the relationship up front, and you pass them on to a construction or a mortgage construction department, and there's a liaison. There's always somebody that's going to be involved with the borrower all the time. So it's just educating them along the way, and every time after they close, this was the easiest process. I thought this was going to be difficult, and it never is. And it's the biggest thing that I ever hear. It's like, you made it so easy. So,
That's why we're number one.
yeah, it really is. It comes down to communication, but it's a smooth process.
So the Florida Builder Statute, there's a notice of commencement that is recorded after our LMC mortgage closes and is recorded. And then the lien waivers, the waivers of lien are required for all the subcontractors and suppliers who filed a notice to owner. So again, back to the clear title and how important that is. And then the final payment affidavit, the contractor's final payment affidavit is completed by the general contractor is required when they get their final draw.
And just to comment about that too, one of the things, being a credit union and always having the members' best interest at heart, what we've done over the last 2-3 years is we always lock in the interest rate at the very beginning. Okay. And typically it's a 12-month construction period, but everything is taking a lot longer just with all the delays and delays and delays. We have not charged anybody a penalty for the delays and we have not increased the rate. So we have some construction loans that have been out there 24 months due to all the delays, and we have not hit that borrower for any penalties or any increases in the rate. So
yeah, and a lot of our competition does. So they penalize the buyer because the builder's taking so long, and that's not fair to the buyer for sure. That's a good point, Jane. Yes.
You didn't mention adjustable rate.
Mhm.
That's only for the.
Oh, no, we have adjustable and fixed rates for both construction and lot. Lot loads are all adjustable.
What's the introductory rate?
Introductory rate?
Well, I mean, like say for instance, the 3% at what amount for how long or
So,
not 3%.
so the way,
3 years.
like our lot loans are 3-1 for, I don't know, so 6 days for 3 years, 5. And those rates are really right now, they're in the mid-5s.
Depending on.
That's not a lot. And if you do anything under 300,000, it's 10% down. If you have a 740 or better credit score. If you have a 680, the 680 would have to be 20% down. But anything under 680, we wouldn't be able to offer. Because it is portfolio.
Mhm.
A lot is, but you'll look at totally trash hurricane damage homes.
Yeah.
We'll get to that.
Yeah. So actually this slide here with, how do you handle it if there's outstanding insurance claims or existing mortgage liens? So let's say there's insurance and the homeowner, they walk away, they're like, I'm done. I can't live in this gorgeous, beautiful, sunny state anymore. And they think they need to move back up north. So if there is an outstanding insurance claim and funds are being held by the previous lender, it has to be resolved between the homeowner and their lender. And then the insurance claims funds that are being held by their lender, they would be applied as a principal reduction on the payoff of that mortgage on the property. And then LMCU, we're going to do an holdback of funds to, renovate, build, rebuild, and make sure it's sufficient to oversee the claim repairs and the renovation items. And then during the rebuild, the general contractor or builder does have to have builder's risk insurance. And then if there's existing mortgage on the damaged property, it will get paid off with the new construction term loan that we do. So we'll pay off that mortgage, we'll get the funds to do the rebuild and then close the loan.
That take a significant more amount of time than a regular construction.
No, it's the same. Yeah, it's the same.
Typically lock those types of
Mhm.
loans for 60 days. So in other words, because we don't do self-builds for the most part, so we're not gonna do a loan like this and then have the owner say, I just wanna do all the improvements myself, when they know they're not a builder and they don't have experience. So we would give them time to get a builder and work through that. I mean, we've closed them in 30 days, but we allow like a 60-day period. to
I have
close.
I have CDP loans that I'm closing in 30 days.
So all you need is the proposal by the new builder.
You need to have a contract signed, fixed price contract.
But what about the contractor?
Along with, the contract has to be approved through LMCU. As long as they have their contractor's license, liability and workman's comp, that stuff can be filed and it can be done within a day or two.
Oh,
It's that quick of a process to get an active builder approved. But again, to submit a construction of perm loan, the only real things that you need is execute a fixed price contract, plans and specs.
What was this, we're again, that lot loan at 10% down?
740.
740.
Okay, so eligible renovations, a lot of people think that it has to be like permanently fixed to the property, and that's not necessarily the case. So if they just need to, add a garage or rebuild a pole barn that's a detached structure, that's absolutely fine. And then the cost of renovation is, based on an itemized bid, where we get the for the itemized bid for the work, and then the plans and specifications. If it is a condo, the renovation work is limited to the interior only, and we have to get the HOA approval. And of course, whatever they're doing, they have to have the builder's permit because it has to be compliant with state, local laws and building codes. Mhm. Yeah, that's what we're.
If you're in a condo situation. Discussions with their insurance company, this gotta wait until that's over with.
So what we've been seeing a lot is, because you might not have been here earlier when we mentioned, like, we do a lot of what we call resort condos in Sanibel and Captiva Island. And basically the whole first floor is gone. Our unit might be on the 4th floor, but we still have to have the first floor substantially complete and rebuilt, which is usually by the HOA's insurance company. So made a couple exceptions where the first floor was, pretty close. But if the first floor is just framed in and they haven't actually done the majority of the rebuild, then it's a little bit more difficult to lend.
The HOA has one walk away from one unit, and the rest of the units are fine, but the other people can't close because the HOA is still talking about insurance because of that one person.
Well, the one floor, if like the entire first floor. Oh, okay. So what does the rest of the condo project look like though? Is it,
Everything else is fine.
oh, then we're good. Yeah, then that wouldn't be a problem. Yeah, yeah. Yeah, so, yeah. Yeah, I mean, as long
We
as,
just have a situation like right now where we closed yesterday on a condo there. And what happened was the seller wanted to sell the condo, but the patio or the lanai, let's say, there is none. It's trash. Right. So the seller agreed to put so much money for repair. So we got a bid. What's it gonna cost to redo the lanai? And they got a bid and they agreed to escrow 1.5 times of their money. So at the closing, we take their money and put it in escrow, even though the condo association is ultimately gonna pay for that.
Right.
The seller said, listen, I need to move on. I'm ready to go.
Mhm.
So we worked it out where we just took so much of their money, put it in escrow in case the condo HOA doesn't fix it. We have to put in some kind of target deadline. So we said, needs to be done by June 1st, because it's only fair to the seller to put in some
But
deadline.
the HOA may never,
And then,
Resolve
then
that
we'll
for a
still
while.
look at it, but eventually the seller's gonna, we can't keep the money in escrow forever. But they just wanted to move on, and so that's what we did, so our buyer did it.
yeah, so I mean, I would consider that minor damage that doesn't affect the livability of the building and the units, but like I said, when you have the entire that is barely framed in, that's a problem.
Yeah.
But other than that, we're looking at it case by case. So I know I'm talking about pole barns and all that, but renovations can be used to, rebuild after a natural disaster. If they just want to do the kitchen or the bathroom or whatever, that's fine. If they want to add a room, add a garage or pole barn, they can even do it if they're just doing landscaping and seawalls. So maybe their seawall was wiped out, but the house is okay. We could still do a renovation loan for the seawall and landscaping, or if it's just the pool as well, too. Yeah, so we can got a lot of flexibility there. Yeah. So our construction perm is a one-time close. So they can either use it to build a new home or renovate or build an existing home. The construction term is 12 months, but as Jane said, if they go over 12 months, we're not going to penalize the buyer. But during the construction part, they draw insurance only when at the end, when it converts to the permanent loan, then they'll start paying principal, interest, taxes, and insurance. So it's nice during the build period that they only have to pay the interest only, because generally they're not living there. So they're probably paying rent or something on top of that. So that helps. So let's see, the permanent yeah, I know that was not too long ago either. Yeah, so we'll go up to 2.5 million, sometimes higher than that with an exception, but we really want to kind of cap it at a 2.5 million loan amount. And we actually do allow self-builds and borrower or buyer perform tasks. We didn't used to do that in Florida on like the home style loan and stuff, but now we do. There's certain parameters around that, but if they are a licensed builder, they could potentially do a self-build.
what if your mom wants to build and they're pulling a permit and
For they can have up to 4 subcontractors involved without having to get a general contractor or builder.
Self-build one?
yeah.
That is, well, I think that would, yeah, I guess that would fall under self-build.
I mean, you're pulling your own permit,
Mhm.
you're gonna hire, so you're hiring up to 4 contractors, you're saying.
Yeah, as long as it's 4 or less. If you're 5 subcontractors or more, then you're looking at having to involve a general contractor or builder.
Well,
I have a situation where people contact me to do self-builds, and they're a truck driver.
Yeah.
So I'm like, what do you do? Question, is it your primary residence? Yeah, and it's like, well, I can do this. And I'm like, well, really, one of the things is that you need to be able to show that. Months to show.
Mhm.
Or that you're contracting that yourself.
You gotta keep it up there. It's not like you can just,
Most risky.
yeah,
thing
exactly.
to do. So if you have somebody, like you said, a truck driver, that just, part of it is where you're gonna get subcontractors. If you're not actively engaged in the building business, why would a subcontractor?
I got a buddy, you always hear, I got a buddy,
Yeah.
I got a buddy, I got a buddy.
Somebody contract now, but they got permits and stuff, save a fortune, because they got one person do roofing, one person do.
And if I'm looking at a brand new build from ground up, brand new build, the only reason we really do self builds for that is if we have, which we have a ton of builders on our, we call it our active list. So if they're doing business with us and we have proof that they've built homes successfully and closed on them, we understand that a builder that's done that, he or she isn't gonna wanna go out and hire another builder to build their primary residence. So we would allow a self-build with more money down, generally it's 75%.
Oh, I always thought a self-built meant you pull permit, but you're hiring the subcontractors. No.
You know, there's not too many
Necessarily.
financial institutions that will even do those.
Oh,
There
maybe
might
they
be, not from the
I
very
have a friend
beginning.
of mine that. I think there must have been.
Or interior renovations that don't require actual permits.
This was a huge garage, they just had.
Oh, okay, no, they had permits,
So
they had,
this, they had somebody else do that,
then they just self-contract.
Well.
Yeah.
oh
So, oh, gosh.
Just if you want.
So the construction perm loan, that the main one that we offer, besides the home style renovation, which I'm going to talk about that one in a minute. So again, just to reiterate, it's the interest only, low down payment. Sometimes they can do as low as 10% down, right?
15.
15 in Florida,
So-
but like with home style a little bit more, but yeah, 15 in Florida. Go ahead.
So another thing about these construction firms, so let's say you own a lot, right? And that lot costs you $150,000 and you want it free fish. You have that equity in that lot, right? So you use that equity as your down payment on the loan. So if you're doing a $250,000 bill, and your lot's 150 equity, really, if you look at those numbers and do it every day, you really only come to the table with 3 months. That's because you had all that equity in the lot that you're already gonna bring.
Mhm.
So that is a great thing, like, like, even though when you see like 85%, I gotta put 15% down. But that lot equity brings a lot to the table, and a lot of borrowers don't.
Mhm. Absolutely. So the construction perm documents, there's a construction contract that's, executed by all the parties. If they are purchasing a lot at closing, then they're gonna have the lot purchased agreement. We're gonna always have the detailed plans and specs and because that's actually what the appraiser is gonna need to perform the appraisal. So the appraiser is gonna appraise it as if it's built according to the plans and specs. Then we get a signed agreement not to commence construction. We really don't want them to start clearing the lot or, doing anything until we actually close on the mortgage loan, because that can affect the lien position. We have to get title company approval and all that. So we hope that they don't start, but a lot of times they do. And then the signed contractor borrower disclosure form. So this form basically allows the buyer to be involved with every draw. Or just be involved with the final draw if they want. So they can be active if they want in what the builder's getting and approve those draws, or they can just approve the final one. And then again, the construction loan agreement, and then the completed signs, builder cost breakdown or draw schedule, which you could have several different draw schedules because maybe you have you have the actual builder and then you have somebody that's going to do the seawall and somebody else that's going to do the pool. So in that instance, we would have 3 different, general or like sworn statements. So here's a sample construction cost breakdown. This is what it looks like where, line by line, what each is going to take. And then this is a sample draw schedule. This is what we see most often. This is what the builders here use most often is the sample draw schedule. And they tell us, what they're going to need at each draw. So how does the builder general contractor request the funds? So the Florida statute doesn't require a sworn statement, but the builders do have to give us, the builder cost breakdown or the draw schedule. And then the draw schedule is the builder cost breakdown. It's a list of components that are going to need it to complete the house. Our underwriters go through and make sure they didn't miss something because they look at these all day long. So they kind of got to make sure that they didn't, miss anything. And then the builder or general contractor would request a payment requisition. So to the draw request, the builder completes our general contractor inspection form. Here, they send it in, and then we make sure that there's the clear title and everything, and then we disperse the funds.
So on the request form, all these are normally, most of the borrowers want to see those requests kind of be in the process because it is their home, right? They want to be out. Most of the time, on that end, our mortgage construction end, there's always going to be somebody that's a liaison that's talking between the builder and the borrower all the time. There's somebody that's a representative of the MLS, which is
Question on the construction duration, the construction. I know a couple of people who have built houses and they want to be in on the inspections
Mhm.
for the draw.
Yep.
Is that something that?
Yeah, so we would allow, so that
Okay.
was that one form I talked about where their consent.
That have errors in.
Absolutely. Absolutely.
And it's not in the middle of the kitchen.
Mhm. Yeah, so we give the buyers that option, if they want to be involved in every draw or if they just want to be involved in the final draw. Yeah, absolutely.
There's usually inspections that are done.
Yeah.
And the appraiser goes out every single time. Yeah. So the plans and specs, we always have to have them because that is detailing, the work that's going to be done. And again, that's what the appraiser needs to complete the appraisal. And, it does detail the materials as well. Like if they're using super high-end materials, that's going to be reflected here. And then, again, it details any work, especially if we have the buyer, completing some of the work as well. That's where this would fall. So the commencement of construction, again, we really don't want them to start, but they do. But we just have to get approval from the title company and the mechanics liens cleared. So here's how the construction draws work. The first draw is the draw that the builder takes at closing, and then they can have up to 6 draws after that. If it's going to be more than 6, then there's an extra cost, but generally 6 is plenty. So at the closing, again, which isn't first draw, it's considered the draw at closing. We get the Florida builder's requisition. Can pay off the land if they were purchasing the land at the closing table. And then the builder can take up to 15% of the construction cost to build, minus any builder deposits. But that doesn't include the realtor commission. Okay, so they can take the draw above the 15% to pay you, the realtor, at closing. And then we close, and then the builder starts working on it. And then the first draw after closing, the builder has to provide the draw schedule, the building permit, any title endorsement, the appraiser goes out. The borrower authorizes if they choose to do that. And then that's when we get the foundation survey. And then 2, 3, 4, and 5, again, all the same things with the Florida builder's requisition form. We get all the title endorsements, appraiser goes out on each and every one of those draws. The borrower authorizes it if they choose to. We get waivers of liens from any prior disbursements. And then the materials have to be on site for the builder to request payment. So the work doesn't always have to be complete. So we're a little bit more lenient here where we'll give the builder a draw as long as the materials are on site. But we will only pay labor when the work is complete. And then the final draw, so this is draw number 6 after closing. We need all the other interim draw requests, title endorsements. We get the final, appraiser goes out and does the final inspection this time, final survey, get the certificate of occupancy, all standing waivers of lien from the prior draws. And this time we get a statement of completion letter signed by the borrowers or the buyers that says this is complete according to my satisfaction. So we always check with the buyer before we give the builder their final draw. And then if they did modify the loan, so let's say they took out a 30-year fixed construction perm loan at 300,000, but they came into more money and they decided that they want to avoid private mortgage insurance and modify the loan amount from 300,000 to 250, they could do that. Modify it from 30-year fixed to a 15-year fixed, but they could adjust the loan amount down. So that would require a modification agreement. And then there's the Fannie Mae home style renovation loan. So this one used to be so much more strict than it is today. So the first one I talked about was our LMCU portfolio construction perm. This is the Fannie Mae home style renovation loan. So this one, we don't do jumbo loan amounts. If it is a jumbo, it does have to go into our construction perm. So it is limited to the $726,200 loan amount. If the cost of the renovation, it can't be greater than 75% of either the acquisition cost, which is the purchase price plus the cost of renovation, or the appraised value, whichever's less. We will allow them 12 months to construct under this program, a little bit more if needed. But with this program, there's no interest only period. They start paying back principal, interest, taxes, and insurance right away. But generally, they're not doing a complete new build. So, you know, sometimes they can live there during this part. So that helps. If they are a first-time home buyer, we can do do as little as 3% down if they meet the first time home buyer qualification. Otherwise, it's 95% on this program. So a little bit higher than what we allow on our construction perm. With this one, we can do investment properties. So if it's a 1-unit investment property, we could do it under the home style renovation, where our LMCU construction perm does not allow for investment properties. And as long as our subject property is a single family. Yeah.
Difference in interest
John, I'm gonna differ.
Question, I apologize.
interest rates between the investor renovation loan and
Well, obviously investment's gonna be higher. So I actually am doing a home style renovation on a purchase of an investment property on Fort Myers Beach. And to be honest, he is doing a 7-1 on, and it was at like 6.5, somewhere around that. Yeah, well, I was surprised for that too, because most investment property, as you know, is usually 1 or 2 points higher than what a 740.
This is ridiculous. I mean, I can believe they can borrow 75% of the value.
isn't that exciting?
Yeah.
So it's a case in point, like houses that are like off Fort Myers Beach, that, you know, that's my bar is buying an investment property. And, you know, he knows that he's probably gotta put like 300,000 of his own money in to renovate it, but he's gonna do that and buy it through this stuff.
He still has the land value that.
Yeah,
Is the
land,
equity.
yeah, exactly.
Mm-hmm. And then we do allow borrower performed work. So again, as if they're an electrician, as long as they're licensed, that would be okay. Or maybe they're, you know, good at painting and stuff, they can do their own work. But if it is something that requires license, obviously they have to be licensed. So contingency reserves, if it is a 2 to 4 unit primary residence and all second homes, or if it's an investment property, a lot of times they have to give us several months payment to hold on to. The draw at closing is allowed for only the soft costs, and it can't exceed 15% of the total construction costs. And then once the loan is closed and the permits are issued, our construction admin will allow up to 50% of a material line item to start the project. So it's a little bit more there. And then the loan can be used to complete final work on a newly built home when the home is like at least 90% complete. So what happens, they're like, oh, we're going to use all my own money. And then something happens and they run out of funds and they need money to complete the project. That seems to happen quite often. So with this one, as long as it's 90% complete, we could step in and finish it with our construction perm loan, it doesn't have to be 90% complete for us to step in and finish it. But as a lender, there's a lot of risk to step in because again, it can affect your lien position. You've got subcontractors showing up and stuff that want to get paid that maybe didn't get paid. So again, it's risky as a lender to step in and sometimes it's like financial mismanagement where they ran out of money, or maybe the builder didn't give them proper costs up front. And then so usually something bad happened if the lender has to come in and finish it. So we do that though. But with the home style renovation loan, it can't be a complete tear down and reconstruction of a brand new dwelling. If they were doing that, they would have to stick with the LMCU construction perm loan.
Janice, did you ask for hold back on,
For
like the renovation part?
yes.
They would.
Yeah. Okay, and then LMCU doesn't offer this at this time. We're working on it, but it's something I definitely want you guys to be aware of, that there is FHA, Federal Home Loan Administration. They offer a 203H, which this one, the buyers whose home has been destroyed or severely damaged in a presidentially declared disaster area, if they've lived in the damaged property for at least a year before the disaster occurred, they would qualify, and it is available to actually existing homeowners or renters whose, primary residence property. So if they were renting and that building was destroyed, they would qualify for this 203H loan. It can be used to purchase a new primary residence with no down payment, so 100% financing. If they have recent late payments, they're exempt if it was after the date of the disaster. Seller concessions, we're starting to see those again. Are you guys starting to see seller? Okay. Yeah, boy, did that market turn, huh? Like I used to have to skip over that part. For years I couldn't talk about seller concessions and stuff, and now it's back. So I added it back into the presentation. So we can do seller concessions up to 6%.
Backtrack. So if somebody's renting a home, okay, and the home is destroyed, they can get this loan.
Yeah,
What's
as long as they live there a year. Well, it's FHA, so we will go,
Yes, right?
generally, we'll go down to 575. But yeah, absolutely. So this applies to, purchasing single family home, manufactured, if it's a condo that's FHA approved. Even if the condo is actually not FHA approved, FHA is doing what used to be called spot approvals. Now they're called single unit exceptions. So we can go in and request a single unit exception if they want to do the FHA loan in a project that's not FHA approved. And planned unit developments, that all qualifies. The debt to income ratio, we want to see their housing payment not to be more than 31% and their total debt to income ratio 43%. We can go higher with compensating factors. And the beauty of FHA, and I do have a whole government lending presentation that I could do, but I mean, FHA is manual underwriting. So as an underwriter, when I do a conventional loan, a lot of times I'm capped at what my automated underwriting system approvals is. And I can't go outside of that a lot of times. But with government loans like FHA, VA, rural development, it's good old school credit risk underwriting where a human underwriter steps in, makes the decision, documents the compensating factors, approves the loan, and we move on. So that's what I love about government loan programs. So for FHA, generally the minimum single family loan amount is $472,030 in most counties. In Collier County, it's actually $672,750. So that's pretty high for FHA. And then we'll do in any of these counties listed here when we do eventually roll it out, hoping to have that soon. But again, I wanted to make sure that you guys are aware of it. And then vacant land lot loans, as little as 10% down if it's 20 acres or less, 80% or 20% down if it's up to 40 acres. We make exceptions on 40 acres all the time. We've closed 60 acres. I think I just saw one that was 80. The underwriter can make the exception up to 45 acres. Minimum loan amount or I'm sorry, maximum loan amount's 500,000. Again, make exceptions all the time, because the beauty of portfolio loan programs is it's our money, it's our program. We're not selling it on the secondary market. We can make all the exceptions we want based on the overall credit risk of the buyer. So if we are doing the vacant land loan, we really want it to be intended to, build, because we use it as a stepping stone to the construction loan to build. We're not going to give them a lot loan in an RV park or anything like that. Or, someplace to just go hunting and stuff. No, you need to be build, and the lot has to be buildable. And then they can gift funds.
What exactly do you have to build? Can you put a manufactured home
Or modular home or panelized home. We do want the manufactured home to be at least a double wide or multi-wide. We can't do a single wide. We can't do a container. Yeah, so they couldn't do like a container home. Those are starting to be popular. It has to be a traditional home, but it can be a manufactured as long as it's at more than a single wide. The funds, they can get a gift for down payment. So that's always nice. And then again, it's limited to these counties in Florida. And then that's it. Do you guys have any questions? Oh, the one thing I did want to point out here. So the vacant land, so let's say that there's a damaged property that can't be rebuilt and needs to be torn down. It's not habitable. They can use the vacant land loan to purchase that lot, and then we'll do an escrow holdback for the demolition of the structure. So that has been very popular lately, especially with like the people that walked away and stuff, and they're not going to rebuild. You could come in with a vacant lot loan and just purchase the lot, and then tear down. We'll hold funds to actually tear down the structure. And then when they do the construction perm loan, we'll come back and just rebuild and pay off that lot loan. So any questions on anything we covered? I really hope we can help a lot of people.